Markets ride a roller coaster of record highs and cautious calm, but here's where it gets controversial. The stock market's recent surge to all-time highs has left investors buzzing. Yet futures contracts for major indexes remain stubbornly flat Thursday evening. This tug-of-war between optimism and hesitation highlights a pivotal moment in the market's rhythm. The Federal Reserve's surprise rate cut this week has investors on edge, sparking debates about whether this is a sustainable rally or a temporary rebound. And the S&P 500 and Nasdaq composite closed at record levels, while the Russell 2000, a bellwether for small-cap stocks, surged 2.5% to its first all-time high since 2021. That's no small feat. Small-cap stocks often lag during market downturns, so their resurgence suggests broader market confidence. Aswath, Damodaran, the famed NYU finance professor, offered a stark assessment on CNBC. The market is being buoyed by strong earnings reports. As long as companies keep delivering, there's no reason for a correction. But his words invite a critical question. Are investors over-reliant on earnings, or is this the new normal in a post-rate cut environment? Damodaran also emphasized that the rally isn't limited to tech giants. It's not just AI-driven stocks, it's the entire market, he said, hinting at a rare broad-based optimism. Yet skeptics argue that this could mask underlying vulnerabilities, especially in sectors like housing, where affordability crises persist. The Fed's rate cut this week has added another layer of complexity. Stocks wobbled Wednesday as investors digested the central bank's decision and its economic forecasts. Thursday's calm, however, suggests the market may be stabilizing. The Dow and S&P 500 are on track for a 0.7% weekly gain, while the Nasdaq has climbed 1.5%. The Russell 2000's 3% jump is particularly eye-catching, with analysts noting it's now riding a 7-week winning streak, the longest since 2020. But here's the catch. With no major economic reports or earnings due Friday, the market's next move hinges entirely on sentiment and external shocks. The dark side of the rally, homebuilding slump. Not all stocks are riding the wave of optimism. Lennar, a major homebuilder, saw its shares drop 3% in extended trading after reporting a 46% earnings slump. Despite beating revenue estimates, the company admitted it would miss fourth-quarter delivery targets. Lennar's struggles highlight a broader issue. Affordability remains a nightmare for buyers. Mortgage rate incentives and price adjustments have done little to spark demand in a market where home prices and interest rates remain stubbornly high. Is this a temporary blip, or a sign that the housing market's recovery is dead in the water? The answer could ripple across the economy, affecting everything from retail to construction. After hours fireworks, while the broader market steadied, individual stocks told wilder stories. FedEx surged 5.8% after crushing earnings estimates, driven by a 3.83 per share profit on $22.24 billion in revenue. Meanwhile, Scholastic plummeted 11% after reporting a 2.52 per share loss, worse than last year's 2.13 per share loss. These swings underscore the market's unpredictable nature, even in a seemingly stable environment. What's next? Futures remain near flat as traders await clarity. But the bigger question looms. Can this rally hold, or is the market setting itself up for a correction? Damodaran's logic is sound, but history shows that even strong earnings can't shield stocks from macroeconomic headwinds. Do you think the Fed's rate cut is a lifeline for the market or just a temporary fix? Share your thoughts in the comments. This is a debate that's far from over.